Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, May 17th, 2024. S&P 500 currently sitting at 5301. I'm David Zarling. I'm here with Ian McMillan, and everybody wants to know, did you get arrested on your way into the country club this morning?
I did not. I was able to flee the scene.
Poor Scotty Scheffler.
That's pretty crazy.
Yeah, I don't understand. I believe there's a tournament this weekend, and that's why he's there.
I'm sure the PGA Tour didn't mind it.
Yeah, a little bit of publicity.
A little bit of extra attention, Some might even say it could have been staged, but we don't need to go that route today.
Yeah, this is not the weekly conspiracy, although that would be a fun podcast.
There'd be plenty of episodes you could make.
Yeah, you could. I don't know. Maybe someday our listeners will wake up and that's what we'll have morphed into. Don't really want to do that, but we'll see. Before I forget, I just want to apologize to those listening. I forgot to wish all those great mothers out there happy Mother's Day this past weekend. Did you guys get to do anything for Mother's Day? I know we think the world of our wives and the way they make our houses homes and raise our children. You guys get anything in for this past weekend for Mother's Day?
Yes.
Or maybe even for your own mother?
Celebrated with my wife and my mom. Fortunately, they don't live too far away. So it was good. What about you?
Good. We went to a Brewer game. Got some worship in early Sunday morning, sang part of the family choir. Then we went to the Brewer game. Didn't get to see a win, but that's okay. I just really appreciate that my wife enjoys sports and enjoys them as much as I do. It's always a good time. But it's time to talk markets. And there's 3 bullet points that I want to highlight very quickly that I don't think we see in bear markets. And that would be that 100% of the sectors, 100% of S&P 500 sectors are above their 50-day moving average. All of them are above their 200-day moving average, and all of them have a 50-day above a 200-day.
Ooh, that sounds like a pretty big tailwind. And that's positive. I've never heard of that happening in a bear market.
Yes.
Never heard of it happening in a sideways market.
Yeah, that would be definitely a way to put it.
Another data point to put in the bullish bucket. Have you ever been in a bear market where JP Morgan was breaking out to all-time highs?
That's a good point. Or things like
there's lots of that
Google.
stuff.
But you're right, JP Morgan being a canary, we've used that comparison
before. We talk about Cummins and Caterpillar a lot. I mean, industrials on a relative basis have fallen off, unfortunately. But those two in particular, I think, look very good. And there's a lot of just pretty basic, Another thing that I think makes this market pretty healthy is someone that likes to go back and forth between growth and value and small caps and large caps. NASDAQ 100 versus Russell 2000 flat since this whole thing started.
You're saying since November of last year, when we saw those breadth thrusts show up, that IWM and QQQ or the Russell 2000 and NASDAQ 100 have the same. You're right. Look at that.
Yeah, you had like a 1-month spurt there where, maybe 6 weeks where Russell outperformed and then gave it all right back. But very, very, very tight relationship the last 6 months. So
I would say, I think we define that as compression, and directionally we don't know which way, but from compression comes expansion, and typically you'd see that resolved in the direction of the primary trend. Primary trend, if I can use that, being higher highs and higher lows, and or a rising 200-day moving average is higher for Qs over, or NASDAQ 100 over small caps. So you would, in theory, expect, it's not a predictive measure, that resolves higher. And then if that does, any which way, it's interesting, because if that resolves higher any amount of weak breath doesn't matter.
No.
And if it resolves lower, that could also be a bullish development because you would have
mega cap summer.
Yeah, mega cap summer. Well, no, that's a good point because
XLK, I mean, tech is back above a relative 200-day.
Well, and one of the exercises that we do is that we look at where is their strength, and one way to do that is, right, we had a corrective April, right? We talked about it being normally abnormal, that we have these type of corrections in markets. They happen all the time. April happened to be one of those months. So then you start to look at what cleared April or early April or late March highs first. And to your point, a large cap summer, XLG and OEF, so the top 50 and the top 100 cleared before the S&P 500. So your larger cap stocks cleared first. Open to that. Open to a large cap summer. I think the fact that the entire Russell 3000 is at new all-time highs.
Oh, wow.
I don't know how we can argue with that.
I mean, look at that. I mean, that looks like a pretty textbook weekly chart retest into the late 2021, early 2022 highs. And if we close the market right now, all-time weekly closing highs.
New highs beget new highs. We know they happen in clusters. You've highlighted that before. How about you? What catches your eye? What are things that you're looking at that are worthwhile highlighting for our listeners?
I think the dollar back below 105 is pretty decent.
Are you looking at a trade-weighted dollar, like a DXY, which is right at its 200-day moving average? Yeah, if that's breaking lower, there's many instances where that tends to big breakdown in the dollar in mid-November 23 was coincident with higher equity prices ripping. And if we see this breakdown below this 105 continue, you could end up seeing the weakest 6 months being a very strong 6 months for the remainder of this period.
VIX is at its lowest level since like mid-December.
Really? Yeah.
So
all the things continue to, all the evidence, I shouldn't say all the things, all the evidence, and that's what we really operate is on weight of evidence. And one of the misconceptions, I think, of technical analysis is somehow it's predictive. It's really not. It's about understanding the supply and demand dynamics, where there's polarity, where there isn't, where there's continued reintroduction of demand, meaning higher highs and higher lows. If the lows are higher, that means market participants, institutions are willing to buy equities at higher prices. And there was support in April, in that April low for a lot of equities. In some ways, I'd make the argument that we're seeing an expansion of risk taking. You know, if you look at emerging markets, it's not like if you feel like the world is ending or that there's some massive event about to happen that you go and buy emerging market equities. That's typically not what you see. And here we have emerging market equities moving higher, and even more specifically, Chinese equities. Is it a reversion to the mean? Could be. Could also be a reversion beyond the mean that we see in Chinese equities.
We've talked about Europe.
Mm-hmm.
Continues to look good. You know, China getting a lot of hype, but India is, I mean, I think India looks even better.
That's a good point.
You know, relative.
Are you using INDA for that? Are you using PIN? Yeah. Are you using small cap India? Yeah, when you look at that?
INDA. INDA. Yeah. So we'll see. I think Europe looks great. I think European financials look great. I think they look better than U.S. financials. They definitely look better than U.S. financials.
Well, we can do that comparison, right? We could look at EUFN versus XLF.
If we're talking about the last decade, no. But
you're just talking,
18 months. Yeah, they look better.
Well, and what's interesting is, okay, if we were to say, broadly speaking, even U.S.-centric speaking, that the bottom, which we don't know as a bottom at the time, for U.S. equities was October of 2022, it's interesting to note how well European financials have done versus U.S. financials since that point.
Yep.
And if European financials are going to do well, I think that bodes well for international stocks overall.
I think it definitely does. I just don't foresee a global bear market when we're buying UBS. And didn't the DAX just go out to all-time highs this week?
Yeah.
Last,
and I know
I guess technically last week, but it's held up well. I think we talked about that.
the DAX is highly correlated to U.S. stocks. Or stocks overall. When the DAX is doing well, I think it's also very similar for Belgium. If you look at Belgian equities, it doesn't have to be.
I mean, look at British stocks. British stocks. I mean, Europe has sucked for 14 years. British stocks, probably the worst, definitely one of the worst over there. And I mean, now I'm looking at a dollar denominated right now, EWU, but I get a lot of comments on Twitter. Oh, it's a blow off top.
What?
I mean, just in general with stocks, like, again, big picture. What Dave and I talk about this all the time. You got to remember we're coming off breadth thrusts from November. And again, we know the 12, 18, 24 month implications of that. And then second, like, you're above 4,800.
Yeah. Well, and how can you say
stocks are up, what, like 10% in 2.5 years?
2.5 years, up 10%.
Yeah. This is not a runaway market. It's just not.
Yeah, there might be runaway stocks. There might be stocks that have like really moved far and fast. But that's the nature of momentum. Momentum begets momentum.
You can pull up a non-log scale linear chart of, pick whatever, NASDAQ, and it looks scary. I mean, you could say the same for NASDAQ. We came back. We basically retested. We didn't quite get there. I think it was actually a little more bullish, and that we actually never even got back to retest the 2021 highs.
I think you brought up a really good point here that I know that you and I have had some internal conversations about, that really we as investors need to think in percentage terms rather than nominal terms. What made me think of that is you brought up logarithmic versus arithmetic charts, right? So arithmetic looking at a nominal move, which makes things look outsized, but when you think in percentage terms,
the same, yeah.
And it's the same concept that we know that investors struggle with the concept of, for example, April. An April corrective move for some in their retirement account could look like half of a year, a full year, 2 years worth of wages in what they used to do in their job.
Yeah.
And we as investors need to understand that we shouldn't live in nominal terms. We should live in percentage terms. That a 5 to 6 to 7% pullback, while on nominal terms, number terms, dollar terms, for some, a $50,000 move on $1 million account feels rough if you're looking at it from the $50,000 level. But if you look at it from a 5% level, very different. And that's an ongoing education process. And then it amplifies when you're talking about $1 billion, you're talking about $1 trillion. That 5 to 7% move feels like a lot.
At this point, when you do it for a living, and I don't say that as some type of it is a percentage thing. I think it's all something that everyone kind of has to go through. And that's good. I mean, you want, if that's the way you're feeling about a 5% move, great that your nest egg is big enough to withstand that.
And just understanding that a lot of things in life are actually percentage. They're not nominal. And therefore, we shouldn't expect the same out of markets. The market doesn't care about the dollar value of your retirement account. Market movements, therefore, on a percentage term, if you are only reading them in a dollar terms, can feel unnerving, even though they're perfectly natural. For example, if we grow a client's account from $1 million to $2 million or from $2 million to $3 million, invariably, mathematically, the percentage moves are going to mean, while the same, will be a larger nominal value. And so it's an ongoing coaching process for clients, for individuals that are new to markets. That
compounding is really fun on the way up.
Yeah.
But when you have that first drawdown, right? And especially as you get to that age, you're when you really the 40s, your 50s, your 60s, you're into your prime earning years. And I think it's harder when there is it's harder when you're retired. You lose 40 grand in a month. You still got a job. Money's still going into your 401k. It hits a little different. There isn't an income or two incomes in the household anymore.
I think that's a great way to put it. Like, hey, I don't have an income. This nest egg is my income, my future income. And you go through a month like April, we totally get it from a pure dollar perspective that if you've got some variance that's anywhere from 40 grand to 100 grand, it feels difficult, but at the same time, it's that same vehicle, markets, that allow you to have the same experience that you did for the previous 5 months, which was amazing outsized returns. It's a natural part of markets. It's the same way to say, like, when you take off an airplane, when you feel that turbulence, it's just a normal part of the takeoff process. It's a normal part of flying on a plane to your destination. Same thing with your retirement account and being involved with markets. Normal pullbacks, 5 to 10% pullbacks, as Ian is often great at saying, while uncomfortable, they don't feel good. They're a normal part of what markets are about. And so we encourage everybody out there to live the percentage life. Think of things in percentage terms rather than nominal dollar terms. Think of it in terms of percentage. Percentages are a way of normalizing experiences. And that way we can experience markets appropriately, regardless of if we've got $1 million account, $500,000 account, a $500 million account. If we break it down to percentages, it's all the same. And that's really where we should be viewing the market through a lens, is through percentages, through logarithmic charts rather than arithmetic. And anybody out there who's using an arithmetic chart is just trying to scare people.
I've had an extremely well-known FinTwit personality, author, speakers at conventions and events tell me that he uses non-log scale charts because he knows it'll get more of a reaction out of the audience.
Yeah, I mean, if that's your end goal, right? If your end goal is to drive interaction, I could see that,
And it looks spooky.
Right. A riot with fires and destroyed shops and everything like that is a lot more dramatic than a peaceful protest. I understand. Like, the dramatic is always going to get. It's why, like, our family doesn't watch nightly news. We just don't, because the nightly news understands what gets the most viewers.
We watch Seinfeld.
Yeah, like,
I don't watch the nightly news.
Yeah, we do not watch the nightly news because they're going to go towards the thing that drives views, that drives clicks, and it's unfortunately the negative rather than the positive. And I get it. I get that arithmetic charts, meaning charts that are based on dollar value rather than percentage moves, are going to drive more interaction. If your end game, and this goes back to media does this too, does the media really have your best interest in mind? No, they're trying to drive viewership in order to sell advertisement. That's the end goal. So very similar for many on social media who might be trying to drive engagement will use things that drive more engagement, which might not actually be the most truthful thing to use. It's a great point.
Spooked, gets people spooked. I've seen a lot of analog charts popping out.
Yeah, can you describe that for someone who might be new listening to this when you say analog chart, what that means?
Someone will overlay a current market environment from, pick an asset, and then they'll overlay it with some. Usually it's done 95% of the time. It's done over, this is exactly how markets topped in 2007 or 1987 or 2000 or 1969, and I'm just not a huge fan of them. I mean, I guess they're kind of interesting.
It's hard because it starts to go into the realm of fractals. Now, we do know that markets operate in fractals, and fractals are, if I can paint that picture for people listening, when you use a microscope on a snowflake, invariably the same pattern at the center of the snowflake expands to the exterior of the snowflake. And we actually see the same thing in markets. But where that breaks down is when you start to interpret analogs, the most famous being like 1987, that, this looks just like 1987, but they'll manipulate the chart. They might change the scale. They might change the time frame. And all of that is where I think sometimes technical analysis gets misunderstood. We're here to say on the weekly trend, technical analysis is the study of supply and demand. It is not a predictive measure. We are not here to tell you that this is what's going to happen in the next 6 months. We don't know that.
I don't think you can have another 1987, but right, because we have circuit breakers. We didn't have circuit breakers then.
Right. We didn't have circuit breakers. Exactly true. But the fear mongering, right? If I write something or put something on TV that's more bearish, it's going to get more views. It's going to get more interaction than something positive. Same with the nightly news. It's just the reality of.
I think that works because, I don't know, I think there's a lot of anger in society. It's like a self-feeding, right? I mean, how can a stock market be going up when it costs me so much to go to the grocery store?
Yeah, when chicken costs so much.
Everything costs so much. Everyone's hurting. Everyone is struggling. How could the stock market go up?
And that's where I think individual investors forget that any inflationary input costs get passed along to the consumer, and therefore stock markets can move higher in inflationary environments. In fact, it's why we're involved with markets. And maybe I'm sick of pounding that drum, but the fact that we're involved with markets has to do with maintaining purchasing power. And so if you're afraid of inflation, the last thing you should be doing is hiding in 5% CDs. Because if inflation is at 8 or 9%, you're already behind. We should be using markets to our advantage, not as something to be afraid of.
But I think people want to tie their frustration and anger about the world to this, organism, the stock market, that really, outside of the extremes, doesn't really have anything to do. Like, you just can't extrapolate your day-to-day or week-to-week personal struggles on what publicly traded companies are going to do and a market that has trillions of dollars moving around on a daily basis. I don't think you can.
No, you can't.
Be angry at the world all you want. It doesn't mean that stock market's going down, or same with you. Maybe I'm just tired of trying to get people to buy into that, because I still see a lot of the inflation excuses. I think that's the backbone of a lot of this. Why is the market going higher when milk is $4?
Well, the easiest way to explain that is like think of
$4 milk.
Think of milk as a stock. That's the same thing that are happening with stocks. It's not like the dairy farmer or the person producing the milk that's getting it to the store is not passing along input costs to the consumer. Same thing with stocks. It's not like they sit there and eat the input costs. And when we look at inflationary environments, which are invariably raising rate environments, when you look back at the last raising rate environment or rising rate environment along with inflation, stocks do just fine.
Yeah.
That doesn't fit the narrative. That doesn't fit what people want to believe. And so dogmas need to be checked at the door and understand that market history matters, that there are previous market environments where we had rising rates, rising inflation, and stocks did great. And commodities did great. And that's the reality of the situation we're in now. And I wonder if it's that unique market dynamic of these 35 to 40 year cycles that exceed, the professional lifetime of many people, or even a retirement lifetime of many people, that you can have market environments where commodities and stocks are doing well, while bonds are doing poorly. Another way of saying that rates are doing just fine. That if we're on that type of super cycle a major cycle upon us where we're seeing rising rates, input costs going up, aka commodities going up, that stocks also can go up in that environment, and that we now see an environment where the 60-40 portfolio is completely dead, that rising rates, aka dropping bonds, no longer match the 60-40 portfolio, and therefore does your financial advisor have a solution for that? For us, it's technical analysis, right? We're going to use the study of supply and demand both on an absolute basis, but also on a relative basis. We can study stocks versus bonds. We can study domestic versus international and identify where the strength is. It is notable to see that there are some areas in the commodity space. I think we highlighted last week, miners, whether it's industrial precious metals or even virtual mining, mining things like Bitcoin. These are things worth paying attention to. And the only way that we can identify when those relationships are changing is using technical analysis.
I agree. I mean, we're looking, so you had, 2021 long-term treasuries down 6-7%, 2022 down almost 30%, 2023 down another 6%, 2024 so far down 8%. That feels like a trend. That feels like a massive opportunity cost. And even if your goal is cash flow, I mean, there's certainly better options than some long duration treasury fund.
Yes, to that. How are people supposed to identify where the strength is from a credit market? We've talked several weeks in a row, maybe even a couple months in a row, about how we're seeing more demand for international credit and corporate credit than we are for U.S. credit. And so do you have a process? Let's say you do have a 60-40 portfolio. Do you even have a process for identifying where the strength is in the 40%? I would say many don't, because they're going to use fundamental analysis, which is too far behind.
Well, yeah, and then who's going to get on their computer and go through foreign bonds and emerging markets and corporates versus munis or floating rate versus high? I mean, who's going to do all that work? All bonds are the same, Dave.
I know the adaptive team does that work. Most advisors don't have that time to dig into the different layers or tranches or slices, however you want to name it, of the credit market. They just don't. They don't have that time. And we're in an environment where international credit is in more demand than domestic credit. We're seeing stocks do very well. There are pieces of commodities that are doing very well. Not all of them. You have to be able to study these things and understand where the strength is. It's not necessarily a broad-based commodity, but there are sections of commodity that are doing well.
There absolutely are.
And I know you mentioned trade-weighted dollar. Anything related to, from a dollar perspective, it could be commodities, it could be crypto, international, anything else you're noticing out of that type of dynamic, a weakening dollar?
Yeah, I still think miners look good. Bitcoin's held in there. All the other kind of, we'll call them altcoins for PC's sake, have held in there. So, yeah, I mean...
What do you think defines an altcoin? If you're outside Bitcoin, Ethereum, or outside like the top 5 in cap weighting, do you think is that the definition of what altcoin is? Because I know what you're saying. You're saying these...
So Investopedia says altcoin is any cryptocurrency other than Bitcoin.
Oh, wow.
Although some include Bitcoin and Ethereum. So Ethereum is not an altcoin. But like your Solanas, all that would be, even if they have a large market cap.
That's interesting. When do you think in our lifetime, our investable lifetime, that changes, right? Because, it's not like we talk about alt stocks. I suppose we could talk about micro cap stocks as being alt stocks, or like alternative investments would be your private equity. It's just interesting that there's probably a time in crypto where that definition definitely needs to change, just because it seems a little irresponsible to label anything outside of Bitcoin altcoin. Your point in the end is valid, meaning Bitcoin looks good. There's even some altcoins that look good. So the broad spectrum of crypto is hanging in there just fine. We don't know what it looks like 6 months, 12 months from now, but there's some signs there that are worth paying attention to.
You're pretty constructive up here, I guess.
What do you think internationally? I know you brought up European financials, Europe as a whole. You talked about India. Where are we at internationally? Are we heading into another 03 to 08, seeing a broad participation in international stocks?
I think it's early to say 03, 08. We got a pretty strong rate of trend here for over a decade. So
you're just talking about U.S. stocks versus international stocks?
Yeah, I think Europe could outperform for another 18 months and not still be in the same rated, downward rate of trend.
Yeah.
12 months.
And time frame does matter. So at this point, I want to highlight Ian, the supporter of this podcast, the Adaptive Select ETF, listed on the NYSE under ticker ADPV. Adaptive Select helps investors access two of the most prevalent factors in markets, momentum and relative strength. Using proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash. During long-term market downtrends, investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. Investing involves risk, including possible loss of principal, distributed by Quasar Distributors, LLC. With that highlight made, any other place you'd like to pivot us for this episode that is worthwhile for our listeners?
Nope, that's all I've got.
Yeah, I would just say I would highlight that we continue to see bullish information. Could we see a consolidation during the summer? Absolutely. But when you've got 100% of the sectors in the U.S., 11 of them, all above a 50-day, all above a 200-day, all of them 50-day above a 200-day. You got the Russell 3000 at new all-time highs. You have a trade-weighted dollar below 105. You're seeing risk-taking out on the spectrum, whether it's Chinese equities, European financials, continued strength out of semiconductors. If you're a box checker, which we're not necessarily, we are weight of evidence shop, but we're not waiting for all boxes to be checked. I think for us, it's about identifying where are we wrong in the bullish thesis, because all of the things I just mentioned are extremely bullish. Where would we be wrong? I think it goes back to your point about S&P 500 below 4,800 or below a 200-day moving average, or even the Russell 3000 using IWV. If that's below its prior high in April, below 299, something worth watching, or even more importantly, the 280 level worth watching. But all the things continue to stack up for bullish behavior, meaning more demand than supply. But with that, Ian, I appreciate your time. Thanks for being on here again. I thought this was a productive episode, and if you guys are listening to this and you love it, please share it. Please give it a thumbs up, high rating, however you want to do it. We appreciate it. Thanks for listening.
Have a great weekend, everyone.